Hello and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted to welcome you to this week's Coffee Break with special guest star David Goodfellow, who is our Head of Wealth Planning here at Canaccord. As regular listeners will know, we are usually joined by someone from the Chief Investment Office, and last week Tom joined us to talk about the market's reaction to the budget. But we thought this week, David, it would be nice to hear from you and have a little think about what our clients and investors should be thinking about and, dare I say, doing in light of the recent budget. We don't really want to repeat all that's been in the media about the budget, so I'm hoping you're going to give us your words of wisdom.
I'll certainly do my best.
And years of experience.
Not too many, I don't think.
Not too many. Lots of years of experience. Just to add a little bit of value about what people should now be thinking about. So if you like what you're hearing, don't forget to hit follow on Spotify or Apple, and you will never miss an episode. So welcome to this week's coffee break. Grab your coffee, listen in for about the next 10 minutes, and let's talk a bit more about budget and financial planning. But first of all, the most important question, as this is the Canaccord Coffee Break, what is your coffee of choice?
My coffee of choice, Jane, is an Americano with a splash of milk. In some coffee houses, that is called an ammo with a dash.
Ah, interesting. An ammo with a dash. Well, we definitely had lots of dashes in the budget last week, particularly dashes of tax and income treatments that we thought might look a little bit modest on the surface, but altogether could have a far greater long-term impact on how we save, how we invest and how we plan. I think it's important that we talk about how our clients and investors could potentially navigate all this. But before we do that, could you briefly summarise the key measures that are impacting individuals?
Yeah, I think it's interesting. All of those small measures just added up to quite a lot. And just to be clear, we're talking about another tax hike of around about £26 billion on top of the 40 that was raised last year.
It's a lot.
The tax burden is now reported to be 38% of GDP, and GDP is being downgraded. So you know, this is meaningful, and inflation is now forecast to remain higher for longer. But it was this, and I'm going to use the overused word now, smorgasbord. I've been using this word for a while. But
you're claiming that you invented a smorgasbord.
Well, I didn't invent the smorgasbord, obviously, but but all these different tax measures, small things to plug this huge black hole that wasn't quite so huge as we had been led to believe.
Indeed.
But I think, we've had a further freezing of the personal tax allowances and NI thresholds. That in itself is expected to raise a further £8 billion by the end of this parliament. We've had an increase of 2% on interest income, rental income and dividend income, which seems to be penalising people who are trying to save.
Yeah, trying to do the right thing.
Trying to do the right thing. And there was talk about everything geared towards growth, and a lot of these things just aren't. They're penalising.
Not supporting investment in growth.
One measure that wasn't even mentioned in the speech was the fact that tax relief on venture capital trusts is reducing from 30 to 20%. Now, that's one area where people really are trying to create growth. So I think, all of these things are raising money, as we know, to pay for some big welfare increases.
Yeah, the triple lock's been left in place. We seem to be paying more to support welfare. Also, this surcharge on houses worth more than £2 million. Did you get any feedback from clients on that?
Actually, for our clients with more valuable properties, I think it was a bit of sigh of relief.
Oh, really? Okay.
That for the really, really valuable properties, it was being capped out at around about £7,500 per annum. But yeah, it had been, that was probably one of the biggest kites that had been flown. So I think that there was a lot of nervousness around the council tax surcharge.
Yeah. So you're getting squeezed all ways, basically.
It's not going away, Jane. It's not getting less.
No, sadly not. Yeah. What do we need to do, David? Tell us.
Well, what we need to do is make sure that we are saving for our retirement.
Yeah. And pensions presumably are still the best vehicle for that? Or
where people can continue to invest in pensions,
Yeah.
it is by far the most tax efficient way of a saving for your retirement.
Yeah.
I think one of the things that we should do is ensure that one's savings are across a range of different vehicles. So we talk about pensions, we ensure that our clients are utilising their ISA allowances. It may become more advantageous to start investing in offshore bonds again.
Right.
Something that we haven't
They haven't been on the radar
singing for a while.
years,
but
no.
with the increase in taxes on dividends, taxes on interest, the attraction of the offshore bond is it gives investors a choice as to when they pay the tax.
Right.
And actually, when you're then in retirement, you may have a lower tax rate. You've deferred tax within this vehicle to a point where you're a lower tax rate and you may pay less tax on exit. So asset allocation, making sure that the right investments are in the right pots. So, for example, if you've got income producing assets, it's very useful to have those in the investment vehicles that grow tax-free. So your pensions, ISAs, and indeed your offshore bond.
Okay.
And then investments that are attracting capital gains have in your general investment account, because the tax rate on capital gains is still significantly lower than it is on income tax.
And what about UK gilts?
So the UK gilts are an interesting one. There's a raft of what we would call short-dated gilts that attract very low interest rates because they were issued during the financial crisis and therefore have a very low coupon, very low interest rate.
Like 0 point something percent?
0.125%,
Okay.
and sort of 0.5.
So even though you're paying a higher rate of tax on the income that you earn on them, you're earning such a low level of income.
Correct.
In terms of that return.
Correct.
It's negligible.
And what has happened is that the capital value of those gilts has fallen to below the issue price, and therefore actually the price that you'll get paid when they give you your money back at the end of the term. And the gain between what you pay now and what you're going to get back when the gilt matures, that gain is tax-free.
And that's capital growth.
And that's capital growth.
Okay.
So again, having those in the own mix. Portfolio and in the mix is a very useful tool. Either
as a standalone portfolio or within a general investment account or something like that.
It's very definitely. We've been talking to clients a lot over the last few years. Those clients who are sitting on large sums of cash, sometimes for a very specific reason or just sometimes because that's what they like to do.
Yeah.
We talk about holding. If you're not going to need that cash for a year, there are gilts that will pay out in October next year, in January 27. And we're encouraging clients to use those.
Yeah, makes sense. What about cash flow planning? It strikes me, and I'm definitely not a financial planning expert, but having a sort of reviewing your cash flow plan for the foreseeable future is probably worthwhile now the taxes have changed and what's going on with interest rates as well. Yeah,
we do a lot of cash flow planning for our clients.
Yeah.
The tools that we use, actually the new tax rates are automatically built into those. I do think that particularly when we're looking at the withdrawal, when you're in retirement and where you're going to get your income from, using those cash flow tools is very useful, because we would advocate that you draw. We try and draw a bit from pensions, a bit from your general investment account, a bit from ISAs, a bit from offshore bonds if you have one of those, to try and reduce the impact of tax on your income. So revisiting your cash flow plan, and also just bearing in mind the increase in taxes across dividends, across your rental income. Fundamentally, a couple of highest rate taxpayers, additional rate taxpayers, nearly 50% of their rental income is going to be going in tax. So that's a significant sum. These things will have an impact on people's cash flows.
And I guess if that couple are thinking of giving money away to their children to help house deposits and things like that, do you not just have to rethink that and the timing of it maybe?
What we're encouraging clients to do is that everybody's starting point should be, what do I need in retirement?
Okay.
What is it that I'm going to spend in retirement? It's a difficult one. And we have clients who have been high spenders in their working life who say they're suddenly going to reduce their spending by 50%.
My husband would love that if that was me.
And oddly enough, that rarely happens.
Funny that.
and then we have those who have had, maybe a big capital event and feel much more comfortable about their spending, but they've never really spent that much money in the past.
Right.
Who say,
they might have inherited some money or...
I'm going to spend, whatever it is, £10,000-15,000 a month. And they've never spent anything like that.
Yep.
Unsurprisingly, again, they rarely achieve that. So having an honest conversation about what it is that you need.
And what do? Do you plug all that information into a piece of software, presumably, and it chugs out...
So you start off with your asset base. When you're still working, we can work out roughly what you think you're going to be saving between now and then, when you retire. And then if we know reasonably accurately what it is that you need in retirement, we can then demonstrate, look, you're going to need a sum of X to make sure that you can last, we tend to run these things until sort of people's late 90s or to 100.
Because I think even though you think you might not live to 99, I think sort of in the back of your mind you want to plan that, because you just don't know, do you?
Well, I think there's two reasons why we do this. One is to demonstrate to somebody that actually, if you don't continue working for a bit longer and have a sum of X, if you're going to spend that in retirement, you're going to run out of money in your mid-80s or early 80s. The other reason is that for some of our more wealthy clients, and they're trying to work out how much they can give away to their children and succession planning, it is a matter of, you're worth X, you need Y to produce your income, and you've got Z, and Z's quite big.
Z's huge,
you can give a lot of that away.
Yeah.
And so
you give it away and still live the life you want to live, I guess.
Absolutely.
Yeah,
That's very key. That's very key.
You touched on having a well thought out withdrawal strategy, and you talked about us working with clients to decide where's the best place to take money from, particularly going into retirement, I guess. So if you've got a pension, an ISA, we touched on offshore bonds, a general investment account, other savings accounts. So what are the implications of having a look at all of those different sorts of savings? And I guess if you've got property or a buy-to-let and you've got rental income coming from that source, you look at all of that, do you?
We take everything into account. And the problem with successive governments making big changes to all legislation and tax is that our advice has to spin around. So, in 2006, we were saying spend your pension. In 2015, we were saying save your pension.
Yeah, okay.
In 2025, we're saying spend your pension.
Yeah. Did you mention to me earlier about dividend taxation?
Yeah.
And it's something really weird that I did not know from all the stuff that I've read in the last few days on the budget.
Yeah, so there's a bit of dividend income is a bit of an anomaly. The rates are odd. And so when I said that they have increased by 2%, with dividend income, basic rate dividend income tax has gone up to 10.75%.
10.75%.
Yeah, that's
very accurate. Thank you.
Trips off the tongue.
It does.
Obviously. Higher rate has gone up to 35.75%.
Right.
But rather oddly,
so those have both gone. So basic and higher rate dividend income both have gone up by 2% tax. Yeah.
Rather oddly, the highest rate, the additional rate, remains at 39.35%.
Okay, I love an exclusive on the podcast, David.
There we go. Not sure it's an exclusive from me but I think it has been quite badly reported in the press.
Yeah.
But interest on your bank accounts, rental from your rental properties, they're now taxed at 22, 42, and 47%.
Okay, so higher than all of the dividend income.
Yeah, and higher than your earned income.
Yeah. Wow. Okay. Interesting. Right. I think we have probably overrun our time, so I probably should sum up what is in my Canaccord Coffee Break coffee cup today. So lots of things going on in the budget, keeping our financial planning colleagues in a job for life, it seems. I think it's important that clients realise there are actions they can take, actually. It's not just doom and gloom. There's some positive stuff that comes out of this. We talked about the importance of cash flow modelling, cash flow planning, just to understand the impact of the changes on people's financial future and consider actually less from a tax perspective, actually what you need going forward and how any changes might impact that. And I guess you, as well as tax and interest rates, you factor in
inflation.
Inflation, and So I think that's really important to know. I think looking at how you withdraw money, you talked about, and also what's in your portfolio, because it might be that you're looking to hold assets that will offer capital growth rather than just income, and perhaps working with the financial planners and the investment directors just to have a look at that in the round is probably worthwhile. So we're here to help. If you've got any questions, please do let us know. coffeebreak@canaccord.com. Hope you've enjoyed it. Thank you very much indeed for your time today. Do come back again and talk to us.
I certainly will. It's been an absolute pleasure.
Thank you very much.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.